All right. All right, great. We can go for it. So, so now we are going to talk about financial reporting. And for me, the objective of today is to better understand, or to help you to better understand the expectation. So over the years, accounting has gone through changes, and from an academic perspective, there's been a shift of so there's been a shift of that this is not just financial accounting, but it's financial and external reporting. So reporting has become a very key thing because reporting recognizes that it's all about communicating the reality of the numbers to someone. And we have seen the power of financial reporting with the likes of Tongaat, with the likes of Steinhoff, with the likes of African Bank. We have seen the impact of financial reporting, that if it's not done right, or if it is not used properly, or it's used unethically, it can result in significant losses. And I think that's where the technical comes in, because it's either an issue of you are technically competent to prepare it, or you are technically competent to audit it. So technical, when it comes to financial reporting, is very important. And that's why, for me, it'll always, and maybe for the profession, continue to be what? Continue to be significant. Because we need to be able to communicate to investors, to communicate to government, to communicate to shareholders, the employees, trade unions, the reality of our financial affairs. So that's where we are starting from. And now, how are we going to? I received this particular WhatsApp from a former student of mine, and they said that they were busy having a debate at work. And when I looked at it, I was like, wait, this is a very good question to start our discussion on, because it will help us to really talk about the approach, or how I get to approach some of these things. And maybe that is the approach that you will also find to be beneficial for you. So this is what he texted. We were having a debate here at work. Our company has recently entered into a licensing agreement for a right to use a trademark in its manufacturing process. Using that trademark, we produce some items that we sold to the general public, of which some we sold during the year and others are still on hand, will be sold next year. The issue we now have is around the accounting treatment of the payments we make to the licensor. I am of the view that this is essentially a lease agreement, and therefore these payments should be treated as a lease payment. However, one of my colleagues is suggesting that since the trademark is used to produce inventory, then the payments should be treated as part of the cost of the inventory. Who is right? LOL. So that is the problem there. So now the question is, if you were one of the people in the debates, where would you have been? Would you have been with friend one, or with the former CTA candidate, or will you be the other person? How do you think we should treat the what? The lease payments, so the payments to the licensor. Will this be lease payments, or will this be just the costs of the inventory? What will you say? Which side will you be at? I just want to hear your view. We'll unpack this problem together, and you will see what is then the expectation. But I just want you to, just looking at it, what will you say? Okay, Ellen says it's a lease. Okay.
I would also say it's a lease.
Okay, Bevan, sure.
I'll take a chance on this one. It depends on how the payments, right, is the right to use something.
Yeah. So in
But
this case, the right to use this trademark. Yeah.
is a lease, right?
Yeah.
But we using this trademark to produce inventory.
Yeah. Yeah.
Is it? I would say is the cost. And I'm just trying. I'm thinking about it now. Is it? Do we only pay this cost for the year to produce all the inventory, or do we pay it on a monthly basis to be able to use this copyright?
Okay.
Because
Okay.
so
Yeah.
so so that is some of the questions I don't see here. So what is the time frame of us paying it? If we
Okay.
pay it for 1 month, do we only use it for that 1 month? Or yeah, there's a few questions. So I'm not too clear. There's a few
Okay.
questions I would have to clarify to because it kind of leans to both. If
Okay.
you are able to use it for the
Uh-huh.
month that you're paying it,
Uh-huh.
then it sounds like a lease. But
Mm-hmm.
if you are paying for it based on the number of items that you're going to produce,
I hear where you're
it
coming
it
from.
would be
Okay.
an inventory cost, if you get what I'm
Okay.
saying. So
I
if
hear
if
you.
the agreement say you are allowed to build 5 cars under the VW name, example,
Mm.
then obviously that cost of that trademark that you're going to pay would be split into the 5 cars at the unit cost basis. So then it would be like inventory cost.
All
But
right.
if you're paying it for the month, you can produce 1 car, no cars, or 500 cars. It sounds like a lease, but that's some of the clarity I would want to get.
All right. Very good. Very good. All right. So we've got this particular problem, right? Um, and that is the kind of things that will require us to apply IFRS. And now the question is, how do we go? If we are to say that we have now all acquired our books and they're sitting right here in front of us, where would we want to open? And I think, yeah, because a lot of you are saying it's a lease, I will then expect you to open a standard that deals with what? With a lease agreement. But then Bevan also presented what? Presented a very interesting dynamic that it will depend on the structure of the payment. But then which standard will then therefore be the basis of where we go in order to deal with either? In other words, will the standard specifically deal with payments for the right to use uh, in this particular context? Or like, where do you even begin, in other words, to unpack this problem? And now on my required or the task that I've got there, I expanded it a bit. That's okay. I understand what the former CTA student was looking for, but I took it a step further and say, actually, now I want everything that we've spoken about there to be in the books. So that's now me. I'm saying that, okay, as the CFO, as the senior financial manager, I'm telling this, what do you call it? Entry level chartered accountant to say, can you help me get everything that I've just spoken about there into the books? So what is then the thinking that one needs to go through? Because we are seeing that there are some words that have been thrown there. What is the accounting treatment, the payments, the production of inventory, the use of the trademark, so on and so on? All right. So now this is then the approach that I want us to be able to master today, and therefore in doing so be able to master the books or the handbooks or the IFRS. So first of all, the thought process should be to identify the issue. What is the issue here? What is it that we are looking to account for? Some statements might be very specific and some might be a little broader. What we are then seeing here from the candidate, they are saying, how should the payment be treated? Then I said, what is the accounting treatment of the above? So the two things are different. What I am asking for is for you to consider everything. But then one might wonder that what is the difference though, Rendani? Because isn't everything there about the payment? In other words, if you ask me to account for this transaction, I will just deal with the payment. But is it really the case? In other words, what is the issue when I am asking for the accounting treatment of the above information? That's number one. Let's always be mindful of the issue. So one of the things that we're going to be focusing on, and when I said that there are standards that are considered to be critical, is because they are so thorough and they're so integrated with other standards that by understanding them, you automatically understand what the other standard doesn't do. You therefore know when you will go to the other standard. Then number two, which is what we are talking about, is the scope. How you initially think about the issues will determine how far you can take the issues. Because like now, I said, how will the payment be considered? Then Bevan came up with what? Came up with another question that might be relevant for our issue to say, how are the payments structured? Because the way the payments are structured, it will either make his life easier or it will complicate it. How so? Because it will now broaden the scope. Someone who had believed it's a lease, their journey is clear, they're going to go to IFRS 16. But someone else who is not so clear, they will want to know this type of payments, in which standard are they then dealt with? Then let me check in that standard. Does this standard only deal with this type of payments, or if the payments now are fixed, will that be different? So that is what then the scope does, because we've got a lot of IFRS and we've got a lot of accounting standards. And what is sometimes complicated about accounting is whether I am hitting all the issues or whether I'm focusing on an issue which is not part of the scope. So I need to know whether this is, or I'm in the right scope, and therefore I'm in the right standard. Because once I know, I'm able to call through the principles applicable in that standard. But if someone says it's a lease and someone says it's a trademark, now we are in worlds apart. Because the one who says it's a lease will be applying requirements of a lease, whereas someone who says it's a trademark will be applying a different standard. So we could be worlds apart. Then when we get into the respective or relevant standard, we then need to talk about what? The accounting treatment. What is the accounting treatment? If I say, give me the accounting treatment, is it a one line? What am I asking for? Am I asking about where you will find this in the financial statements? Am I asking how it will go into the books? Or am I asking what you will do when it's in the books? What am I asking for? What does that statement mean? When we get a question and says, discuss the accounting treatment, what does that mean? Then presentation and disclosure. How is presentation and disclosure different from the accounting implications? So this is when we say we are there when it comes to financial reporting, we are able to do all these four things. One, identify the issue, understand where we're going to be referring to get the right principles relating to that issue, and applying the accounting principles to that issue. And lastly, depending on the scope of the question, to go to the extent of telling us where we're going to find that. So you might also want to understand, what do I mean when I say presentation and disclosure? Is that not the same thing? Don't we just present everything in the financial statement, and by doing so, we are disclosing it? No, those two things are not the same. So this is what we want to be able to do in our accounting phase. Identify the issue, identify the scope, or understand the scope, apply the accounting treatment, and decide whether you need to present and disclose the item. All right, so now let's just go into it.